Hey guys, welcome back to the channel and welcome to all the new subscribers. Thank you guys for joining me. Today we're going to be looking at paying off your mortgage versus investing. Now, if you follow the teaching of Dave Ramsey, he says go ahead, take care of the mortgage, pay off the mortgage, that there is an unspoken rule about paying off the mortgage and a psychological aspect of how you should and why you should, because the grass is greener when you do have extra money to pay off the mortgage and when it is said and done, giving you the ability to invest. But the financial side of me and the financial counseling side of me says invest the money instead, which that's what I want to break down, guys. My personal opinions, I want to show you some of the pros and cons that is really into this. Now, this is a video that I did quite a while ago. I was kind of on the fence to how I was going to do this, and I'm going to give you at the end of this exactly what we're going to do. Now, let me know in the comments what you guys think, if you're going for the mortgage early, if you're going to investing early, and again, we're going to break it down and see exactly what it looks like. Now, paying off the mortgage early, this is putting extra money towards the principal. Might make sense to pay it off early if the rest of your debt is paid off. Now, that is really one of the key points, guys. If you have no credit card debt, if you have no vehicle debt, so if your auto loans are paid off, then it is time to focus on the mortgage. If you watch Dave Ramsey again with the baby steps, this is baby step, I believe, number 6 is tackling the big dog, taking out the mortgage, which again might not be the most beneficial, and it's going to be a determining factor that we're looking at. So paying off the mortgage, some of the pros on here, guys. Number one, of course, the biggest, most prevalent one is you save on interest. Depending what your interest rate is, and this is going to be a very important part, where if you have a 5%, 6%, 7%, possibly even higher, depending on where your mortgage is, you're going to be saving a lot of interest. This is also going to lead to you being completely 100% debt-free faster, which of course is the goal of this channel. We're really looking at the financial education, but also the financial freedom point. Guys, when you don't have bills, when you don't have debt, when you don't have credit card debt, all of a sudden you have money. It is an incredible concept that the more you take home in your paycheck, the more you keep of your paycheck because you do not have the bills. Now, home equity is the next kind of pro, where if you do need to borrow money, you do build equity in your house. The faster that you're paying it down, the faster the equity is going to build. That way, if you are looking to do renovations, home equity, anything of that nature. But again, there's not a big reason, and this is kind of one that I'm kind of on the fence with, is if you're paying off your house very, very fast, just to take out a home equity that is at a much higher rate. Again, mathematically, it goes back to not making sense. And then of course, freeing up more room in your budget. Imagine if you didn't have a mortgage, once it's paid off, you can invest it, you can go on vacations, you can do whatever, because most people are paying $1,000 to $1,400 a month just in principal and interest, not including escrow, not including insurance, just the straight mortgage itself. Now, some of the cons for this, guys, is the opportunity cost. Now, every single dollar that you're putting in access onto the principal of that mortgage, you could be putting money somewhere else. So every dollar, like I've always said, every dollar has a purpose. You know exactly what it's for. But if you have a lower mortgage rate, it could make more sense to invest. And again, this is kind of where I'm on the fence with this whole thing. Now, another big con with this, guys, is the liquidity aspect. If you're putting money into the mortgage, there is no way to really pull that out short of a home equity or a product like that. Once you put the money in there, it is not easily accessible and very fastly accessible if something does happen where you do need an emergency fund or you need extra cash to actually get the full value. You would have to go ahead and sell that. Next con is the loss of the tax deduction. Now, with the standardized deduction that has changed, this doesn't really affect many people. You're not writing enough when it comes off on the taxes, which of course, seek a professional tax advisor. But for, I believe they said 92% of Americans, you do not have enough standardized deductions to cover what it is for the standardized deduction. And the final one, guys, you have to be very careful, is a prepayment penalty. Now, there are a lot of mortgage companies that can have an absorbent amount of a prepayment penalty if you pay it off. Financial institutions are relying on the interest that they receive from the mortgages, so make sure you check with the mortgage provider to see if there is a penalty to pay it off. Now, on the flip side of that, guys, is the investing side. From a financial perspective, you could earn a higher rate through an investment versus paying off your mortgage, so it could be a better option to invest. And again, this isn't going to be ideal for everyone. It could be I'm paying off the mortgage, it could be I'm investing, it could be I'm doing a blend of both, which again, we're going to talk about in just a little bit. And the reason is there are a lot of determining factors for that. Now, investing the money, pros, number one is the higher rate of return. If you did a refinance in 2000, 2001, 2002, chances are you probably got a significant lower interest rate. We have seen low rates as low as 10 years going at 1.75. We have seen 15, 20, even 30 years going as low as 2.5%. When you look at the average return return of, let's say, my favorite, the VOO or the S&P 500, where you're yielding an 8 to 10% return on an annual basis. Now, it is not year over year for that return, but when you look at a 5-year, 10-year period, on average, it is about a 10% return. What would be the reason to pay off your mortgage at 2.5% versus getting a return at 10%? Fundamentally, you could put the money into an investment, invest until you hit the principal amount or the amount that is owed on the mortgage, pay it off, and be done at that. Another big pro with this, of course, investing, you do have liquidity. All you have to do is sell your investments. It is very easy to have access to that money, where again, on the other side of owning the home, it is very difficult to get the money out of there. And then of course, the employer match. When it comes to investing, if your employer has a match, 100%, bar none, guys, you have to take advantage of the employer match. It is free money. It is absolutely shocking, even at my employer, that we have less than 90% of people taking advantage of the employer match, because that is literally free money that you're leaving on the table that your employer is just taking back. Now, some of the cons, there is a risk associated with investing, guys. Anytime that you put money into the stock market, there's a chance, just like 2022, that the investment could see a big downside, a 20, 22, 25% downside. But again, if you're putting that money into the home, you know it is not going to go down. You know there's not going to be a negative return like what the stock market yield. And then of course, the biggest one, guys, is you are not eliminating the debt. You are going to be carrying the mortgage. And this really is another pet peeve of mine, where if you take a loan out for, let's say, 5 years, 7 years, even no mortgage for 30 years, I am not one, and I do not recommend it for you, that paying for it the full term, guys. You want to eliminate debt as much as you can. As soon as that payment is done, not only are you eliminating that payment, but you're also eliminating the interest side of the payment that you're paying to the financial institution where you are borrowing the money from. So again, that is a really, really big thing. But let's break this down, guys, and then I'll go over exactly what I'm doing. So which option is best for you? Number one, you have to look at the risk tolerance. With the investment side, there is a considerable amount of risk depending where you're putting the money, which is the reason why I try to mitigate the risk through M1 Finance. Again, always have that affiliate link down below, but putting my money into something that is going to spread the risk with a pretty good return is what I'm looking for. But again, you really do have to take this into consideration, guys. Is remember, if you're paying off your mortgage, there's no risk. You're putting extra money, the balance is going down, but putting it in the market, depending on how long you have left, you could definitely see some better returns in the market. Now, this also talks about the time horizon. So if you have 5 years to pay off your home, chances are it would be a lot more beneficial to put the money towards the principal, pay that thing off a little bit faster versus investing it, because if the market is volatile, if the market does go down, chances are in a 5-year or a short time frame, you're not going to be able to make up the difference by investing versus putting it into a mortgage. Now, this is the big one, guys, the mortgage interest rate. Depending where your mortgage interest rate is a huge determining factor, guys. If you have a 3%, if you have a 4% mortgage, the typical return on an investment is roughly 8%. You could put the money into an investment, keep the difference, even if it doesn't perform at that 8%, even if it performs at a 3% where your mortgage rate is, you're still going to be at a break-even point for that investment. Now, also looking at the opportunity cost, this is one that we talked about, is if something comes up where you need money, or if there's something that you could potentially put into an investment, whatever it may be, even a lot of the opportunity costs I look at, guys, that a lot of people forget to invest in is themselves. Reading books, consuming content, things of that nature, spending money on college to better yourself for the longevity of yourself is really a big, big part. Now, what is the overall thing that I'm doing that we were talking about, guys? I am doing both. So what I do every single month is I have a set amount that I am putting into investments, like you've seen with the VOO strategy that I have with M1 Finance, and I have a set amount that is going into the mortgage every single month. So I'm turning a 30-year mortgage through contributions on a monthly basis into about a 10-year mortgage, which is the plan that I wanted to do. By the time that I retire, I do not want a mortgage by any means. I want that mortgage to be gone by the time that I get ready to retire, which most of you know is in now 6 more years. Just had a birthday on Sunday, but I want to get that paid down and I want to get that done before retirement is knocking on the door. So again, putting money into the investment, putting money onto the mortgage. And again, I limit what I put onto the mortgage because I know the return that I'm getting with the investments and the dollar cost averaging that I'm doing. So my plan, every 2 weeks, guys, I do put money into an investment account. When I get paid every 2 weeks, I do put money towards the mortgage as principal payments. And I'm going to continue that again next couple years with what I'm paying extra. The mortgage will be paid off in its entirety. I will still have a considerable amount in investment accounts, not including IRAs and 401ks. So that is really it, guys. Now, seeking financial help, look for financial advisors. There's a lot of them out there, and really look at the alternatives that you can do, making sure, again, this is a strategy you want to use to pay down the mortgage or invest once the high interest debt is gone, once the emergency fund is done, and once you have invested in yourself. All right, guys, so that'll do it for today's video. Let me know in the comments what you guys think about the strategies, and as always, thank you guys for watching.